Hey everyone, Nick Shaheen here looking at Kohls. I usually like to, they reported earnings before the market opened, and obviously the market is not liking what they saw. Down big time, almost 20%. So clearly, I like to catch falling knives if I see, first of all, value, and more importantly, a level which technically is viable. So regardless of what I think, if the chart doesn't agree with what I think, I don't take the trade. And if there's no premium, I don't like to do it either. The way I catch falling knives is by selling puts against what others fear. So if you think the stock is going to zero, I'll say, okay, I'll sell it to you at zero. Well, obviously, making a joke there, but at whatever level. So this is a 4-hour chart. A lot of people look at that. You can see that it had a nice rally off of the early days of October. 30%. So if somebody wrote it up and didn't close it into an unknown event, that somebody was gambling. I don't care how solid of a fundamental story it is. The earnings event overnight is a complete gamble. If they give you the P&L, you couldn't guess which way the market is going to take it the next day. Sometimes I remember years and years ago, I haven't used that example in a long time, Google, before the split, they reported, and then I think it was Sergey's first quarter back into the leadership role. And he had only said like 137 words or whatever. Somebody counted the number of words and they sold the stock $100 just based on the fact that he didn't say much. Turns out he had a throat issue, which he still struggles with, or last time I checked. So you don't know what they're going to do, the investors, with the information they get. So another reason one should have booked here, if I look left, I have a box here. I don't know where that box came from, so I'd have to go see it. So I'm going to go to a daily chart. Okay, so now I get a little more information. That box was a pivot point at some point, but I still need more information. So just based on this one, I can see some things that are not as clear, but some people believe in Fibonacci. They believe in it because it's actual math, so it's not fake. So check this out. I'm not a hardcore Fibonacci guy. Clearly, this setup is the basic setup that comes out of the machine. I didn't set it up for myself. I took the extension from here to here. So this correction, which was fantastic, huge, by fantastic I mean it's big. And this right here is exactly 50% of it. So more to it. It matches exactly this level right there. So these are not coincidences, people. This level right here matches exactly where the ledge was on this last earnings report, 2 earnings reports ago, I should say. So these are not coincidences. This is where they landed first, right here. This is where they failed on the comeback again. This is where they overtook, and now they had an inverse head and shoulders that targeted somewhere up here, but they weren't going to slice through this like butter because this is the 50% retracement and the level from here. So this was the ledge in the middle of this gap. So ideally, they should have filled the gap, but there was an event that foiled them. That's fine, but the levels were there. So what if I expand more time? So I'll go to a weekly. So now we're looking at 5 years, I think so. Yeah, 5 years worth of data. And this is the box that I have right here. Markets are open. Tesla's going bonkers. All right, so this is the box that I mentioned. And in fact, it goes left. I should have extended it more. And look at this cluster of stocks right here. So this cluster right there, these are weeks. So it spent more than a month inside this box. The same box, if you look right, it's the same box that we're talking about here. And this huge spike and huge ledge, they took it out in 2018, held it through a whole bunch of troubles, and then finally lost it recently. Not last year. They lost it this year when markets were setting all-time highs, basically, this stock is struggling. So clearly, I need to go see what the heck is going on in the chat room. I'll be right back. All right, we muted that. They were asking about targets report and I think lows and all of that. So back to this one. The point is, this was a bookable moment. When I have profits, it's an art as to where do you get out. If I have no problems leaving money on the table. So the ideal inverse head and shoulder target was higher. It should have filled the gap. It didn't. So I would have been okay exiting before the earnings and missing out on a bunch of greens. But now you turn a profitable situation into a complete loss, which is shameful. I don't know what they said. They must have said something horrendous. And this box should be expanded to the right. And next time it comes about, somebody needs to pay attention to it. So the levels are not random. That's basically the story here. From different time frames. We started with a 240 time frame. Now I extended the box. So the box was an area where somebody should have thought about booking. That's lesson number one. And then we went to a daily time frame. That showed us that the extension was exactly 50% of the Fibonacci retracement level. Ignore it, look left, and you see why that was an exit point. This was the ideal carrot to fill the whole gap, this gap. They didn't. They ran into a wall, which was the pivot level from earlier. So this is a kind of a hindsight lesson to where if somebody didn't book profits, next time maybe they do it. So is it a time to catch the falling knife? So having went to a weekly and having seen the size of this move, I rarely see moves this big that are just one-day events. So this is a big move right here that followed through. On top of it, the markets are at all-time highs. So catch this knife and then the market's correct and then you end up with double the headache. So this, in theory, is support. It's proven support. It has held through the worst of this year. But this year wasn't so bad. So how tough a test is it? Last year's December tests were tough for all the other stocks because everything was bad. And that was as tough a test. But here, I'm not sure. So, plus, if you look in the options market, I bet you there isn't that much heat in the premiums. So I would have to look into it. Maybe I was looking at Home Depot. I can't remember. So I'd have to look into Kohls to see exactly what the premiums are. But if I can't sell below 40 and collect a hefty premium, I'm not going to do it. I'm not that hero. I'd want to hide at least inside this cluster where I'd say to somebody, okay, I'll buy your shares. I'll buy your shares at 38 or 37 if they go there. But until then, I'm not that brave. There's too much going on here that could be like stool pegs that could be taken out. I'm not sure. So the whole market is so bullish, and this one can't find footing. Even coming into, yes, it had 30%, but it was in the toilet before it had a 30% rally. So I am missing a piece of the bullish puzzle here. So, okay. So here's another one. Let's mark this up a little bit on a weekly basis to see if we can come up with a reason to chase it. By the way, I drew this cup and handle and forecasted this pop. So I'm not like a perma bear on the stock. I don't have any trades on it, so I'm agnostic. Here was another cup and handle-ish, well, a neckline that was taken out, and check this out. This is exactly where it's at. So this level here and these actual bounces should provide some solace to somebody who's long the stock. This, in theory, should be support. If not, this should definitely be support, this whole zone. In fact, this little orange line here, this is 5 years worth of data. The meat of the range is this one. It's pretty wide. So this is the volume where it happened at the price. So this is the volume down here where it happened in time. This is the volume where it happened in price. So it tells me that most of the action was down here. So this is called the point of control for the volume profile. So, but it's actually like almost a tie between all of this chunk, which solidified the fact that anything down here is support, but it's a big rubber band. That's a huge mattress. It's not a hard line in the sand, even though right here is a hard line in the sand. But this is a pretty scary candle. This is, again, weekly, but it's 1 day really minus 20% almost. So these are all the thoughts on Kohls. So is it going to zero? Clearly not, but it's falling into support. But unless I can get paid real well to sell a put, I'm not going to sell it unless it's below 38 eyeball. Do your homework on it. Fundamentally, not sure what kind of... I mean, they have a deal with Amazon. I walked into Kohls actually a couple of weeks ago. I was returning something for Amazon because they have a mini store inside. So it's 13 PE. Sounds cheap, but I think all retail is like that. It sells halftime sales. So let's test that. What's Target? Target I know is expensive because it's done well. So you get what you pay for. So Target's PE is a little more. Price to sales a little more. But the stock is so much better from memory. How about Macy's? Another turd stock. Not the company, don't hate me. 5 PE. Talk about cheap. And I think they pay a dividend too. 0.2 times sales. So there's no respect for Macy's. Absolutely none. And they do pay a dividend. So, you know, cheap, maybe, but it could get cheaper. It's not reason enough to buy it just because it's cheap. All right, Nick signing out.